CAFFYNS. Have you ever heard of CAFFYNS? Well, I sort of have. And what do they do? They sound like they do something like do coffee or something. So let's look at the MicroCap League. There we are. It's ranked 122 out of 137 companies. Let's click it. Let's see what the company is. So CAFFYNS sells new cars and used vehicles. Already I'm thinking they've been on the cost a little bit recently, car sales, because a lot of people buy their cars on finance. Finance is expensive. I'm thinking now sometimes you get recovery plays. Just think, is it a potential recovery play? So the car dealer in the southeast of England, it offers a stock of new and used vehicles for sale at 18 locations across Sussex, including brands such as Volkswagen, Audi, Seat, Skoda, Vauxhall, Volvo, MG, LVC. What's LEVC? I've not heard of that. Lotus. Anyway, and the rest. So here's the tail of the tape, ladies and gentlemen. Share price, 4.5 pence. Target price, 8.4. Now, I couldn't find a broker note on these, which is annoying. I put all the figures in. So I've literally estimated this off my forecast using quite low multiples. But will it get there? We don't know yet. That's just a target price. Don't always think, a share price will hit the target price just because that's the target price. Now, they are a tiddler, 12 million market cap, enterprise value, 23.5 million. Now, what does that say? That says they've got more debt than cash. Enterprise market cap is just shares times by the share price. Shares in issue time. Now, enterprise value takes into account cash and debt. So it's a lot more effective way or accurate way of measuring a company's sort of value. So we're seeing there that the net assets, by the way, are 10.54. So net assets, if you sold off all their stock, everything they have, clear the liabilities, all that stuff, then you still have £10.54 share. That's what they reckon. Of course, who knows? You see, accountants are independent. I don't know, but they say that anyway. So volume is literally hardly existence. It's over £9,000 a day of stock traded here. It's not a lot. Revenue, 262 million. Straight away, I'm saying to me, they've got small margins because if they're doing that, then that's their revenue. If it is 110 sales, this will be worth 262 million. But they obviously margins are very small. So anyway, they made this is results to 31st of March 2024. Operating profit, nice to see, it's in the green, 1.5 million. Cash, 438. Debt, 11.7 million. Operating cash flow, but they are cash flow positive. Well, operating cash flow positive, 120 grand. Free cash flow there is 2.2 to the negative, no dividend. That's what total scores here. Total growth 3%, top line, or in fact, total growth is this. The top line was 4%, by the way. Everything else went down here. Value seemingly good. Health, efficiency, momentum, and potential. That's my potential. Okay. So here we are. 4% top line, operating profit there. So value, literally on nothing times sales, so 0.01 or something. But a PE of 10, price to book is, look at that, that's good. I said price to book, same as net assets, basically. So the assets are worth more than the company is listed for. EV/EBITDA of 8. So that's the health, the value seems to look good. The health is questionable because they have got net debt of 11.3 million. That means they've got, even if you take the cash off the debt, that's what you're left with. So ideally, you want a company with net cash. Gross gearing, so literally debt as a measure of their assets, 41%, but the current ratio is fine, so they can cover their current bills the next 12 months. Efficiency, gross margins, it's in the red, 12%. It's not a huge. I'm looking generally, 40% plus there. Operating margins, it's wafer thin. Return on capital, again, at least they do have a return on capital, but it's very low. Looking above, you want double digits there, really. And there's no momentum here. Let's look at the other chart for a second. CAFFYNS. Sounds almost Welsh, that, it's a very bitty chart. So we go back to 2015 here. It's come down. Of course, there's a COVID dash for cash crash. It rallied nicely from 252 up to 560, and now it's rolled over a little bit. It's a bitty chart, and that shows essentially when there's not much data going through, not much trades happening, that shows it's why it's quite bitty and it's a little bit thin, you know. Okay, let's just quickly go and scroll down. So what do they do? Yeah, 262 million top line growth. But even the EBITDA is 4 million on that. So literally 1.2. So the margins are wafer thin there. Forecast, but even if they do 3% top line growth, which you think lower interest rates, they may do that. People selling more cars, slowly improving margins, right? In fact, kept the margins as they are. And if you do literally 0.1 of sales, 3 EBITDA multiple, 5 PE, you're looking at, 86% up. That's what you're looking at on those multiples if they achieve modest growth, 3% top line, and keep their margins where they are. So what do you think, ladies and gentlemen of the jury? CAFFYNS, what are you saying? Yes or no? Alex, CAFFYNS, no. Low margins. Chris, I tend to avoid investing in any company with a dodgy name. That can be a Mac person name, though. CAFFYNS, yes. I don't say CAFFYNS, no. Gareth, too much debt and risk for low profits. Yeah. Not for me, Alan says, and margins. And Rocky is low return capital in equity. I'll stay caffeine free. Thanks. That's good. Well done, Mark. I'll stay caffeine free. Nice. Mark Noblo, 200. Oh, I didn't even look at that. 200 moving average. Let's look at that. Yeah, sorry, it's no momentum. So you can see here, it's rolling over, the share price is down. And if you go back to here, again, you can see where the clear uptrend has happened. It breaks the 50-day moving average, golden cross here, and it stays above that 200-day moving average on the way up there. So you can see a nice uptrend there. And now, conversely, we've got the opposite of that. We've got this gold death cross happening, and the share price is below that average there. So you want to see people paying up for the price on a consistent basis. That would push the share price up, and that would keep it above the moving day average. Okay. Mark says no. Brian says no. We'll give it a miss. Nev, buy-up potential has to be good with our price to book. Yeah. Well, if they start, well, in fact, they're not losing money, are they? So if that asset value is going up, you get value investors will do that. That's like that's kind of like early on Buffett sort of Graham-esque, buying companies below the net book value, the book value, by the way. There we are. So, but you know what? There's so many more companies out there now. You can take a choice. You don't have to say. So, Phil says that ignore tighter in this market. Check under the bonnet and wait for it to motor again. Hey, the opinion on that one is ignore.